So Chamath Palihapitiya just shared what he considers to be the single biggest threat to the stock market today. So in this video, we're going to take a look at what Chamath believes could cause a drop in the stock market. Quickly, I am not a financial advisor, nor is this financial advice. Okay, so let's get straight into it, and I won't make you wait. Let's just jump straight into this first clip with Chamath, where he talks about the single biggest threat to the stock market today.
What's the number one macro uncertainty or risk you guys are most worried about for your investment portfolios?
There is only one, and I think it's inflation. But I think it's important to understand where inflation is coming from. The single biggest risk to all of us is what's going to happen in the following order of operations. So I think all of this sort of coming out of basically what you're going to have is like 4 or 5 major trading blocks in the world, right? You have China as a standalone. You have Europe as a standalone. You have America/North America under Biden. I think it could be more North America as a standalone. And then you have these sort of what I would call random, friends with benefits. Africa, South America, Japan, Korea. Okay? But those are all bit players to these 3 huge trading blocks. Everybody was going to go and get vertically integrated. So it sort of builds a little bit on what David said. Like, you're not going to have, one central place where you get this thing, basically, i.e. China, that you ship on a boat to get over here for a whole host of reasons, national security, carbon, etc. So you're going to have all these vertically integrated supply chains and resilient economies. You know what that does when you have to try to build that stuff? Prices go screaming higher. Because instead of having one factory in China making 9 billion iPhone cases, you have now 50 factories all around the world, each with their own infrastructures and costs and whatever. And so I think you're going to reflate the world. I don't know when it happens, but that's sort of the biggest risk to all of what we do, is that all of a sudden, real rates go to like 6 or 7%. And then all of a sudden, you're not going to look at a company trading at 50 times earnings and say, you're going to question that.
So Chamath thinks that the single biggest threat to the stock market today is inflation. Today, the inflation rate is relatively low. Most major economies aim for around 2% per year. In the UK, it is estimated to be just 0.7%, and in the US, 1.4%. Although, as we can see here, inflation in some very important categories, such as food, is higher at 3.8%. For this reason, many people actually question whether real inflation rates are actually as low as they say or not. But that's a topic for another video. The point is this: people are expecting inflation rates to continue rising as the world begins to open up more and more. And rising inflation rates are bad for the stock market. Why? Well, think about it like this. Let's say you have some money saved up and you want to do something with it. For our example, we've got these cups. So the first option, this cup here, is the stock market. You can put your money in here, and on average, you're going to get a decent return per year of about 7%. Although some years it's going to be higher, and other years, you're actually going to lose a little bit of money. Now, option number 2, you can put your money into a savings account or into bonds. That's this cup here, and I know what you're thinking, Tom, why would I put my money into something that earns that little per year? And some bonds, in fact, are even negative. Well, the answer is, outside of an emergency fund, I'm going to guess that you probably wouldn't. But what if I tell you that the bank isn't paying you just 0.2% anymore? What if I tell you they're actually going to top this up and make it 3% per year? Now, what would you do in this situation? You might still want to put your money in the stock market, but you probably have to think about it a little bit longer this time. After all, it might just be 3% per year, which, let's be honest, it isn't great compared to the stock market. But it's 3% guaranteed, meaning unlike stocks, there's no risk of a crash. You see, as steadier investments like bonds or saving accounts begin to offer higher interest rates, they become more appealing. Now, for you and me, maybe not so much, because we're trying to grow our money and 3% isn't exactly the quickest route to do so. But for major institutions looking to hedge their money, well, today they look at bonds and they aren't exactly interested outside of the minimum they have to hold. However, as interest rates rise, as that second cup begins to fill up, bonds begin offering a higher return, which essentially means those institutions may move some money out of the stock market and into bonds. And that is what could cause a drop in the market. But why would interest rates rise? And what does this have to do with inflation? Well, it's because central banks use higher interest rates to curb inflation. So if inflation starts rising too rapidly, there's a chance that central banks like the Fed or the Bank of England will hike up those interest rates. And if they do that, investors can then get those higher returns in bonds, and that's when it could impact the stock market. Now listen, we can sit here and talk about whether interest rates are really about to be raised or not. I mean, after all, the Fed has discussed allowing inflation to run past 2% as they aim for an average of 2% this time around. However, as we can see here, interest rates are at historic lows. So whether it's this year, next year, or the year after, rising interest rates are really just a matter of time. But there is a counter argument to this point by Chamath. So Cathie Wood has been talking about inflation recently too, and she shared her thoughts on why she doesn't think inflation is going to rise that much. And as a result, interest rates won't need to be raised too high either. So let's take a listen.
Another worry is the impact of interest rates on PE ratios. And that is why high multiple stocks have been hit hard here. Well, one of the things that has puzzled me over the last, I'm going to say 10 to 20 years, is as interest rates were falling, and I believe in the tech and telecom bubble, they were starting from, this is a 10-year treasury, 6-7%. As they've come down, and we bottomed at 0.5% during the, as they've come down, what was interesting to me was PE ratios, which should have gone up, because of the discounting of future cash flows, and these lower and lower discount rates. They seem to always top out in the 20 to 25 range. Now that's an earnings yield. If you do E over P, you've got an earnings yield in the 4 to 5% range, right? Okay, so it topped out 20. What this tells us is the equity market has never incorporated 1% or 2% or even 3% into the valuation structure of the market. And in fact, if we are right and the nominal growth in the economy is not going to be 4 to 5%, which we believe is the normalized rate that the market has been baking in. So 1 over 4% would be a 25 multiple. Again, just quick and dirty way to think about this. Or 1 over 5% equals 20%. I mean 20 times. We've never been able to get through that. But what if the normalized growth rate is actually 2 to 3%? And you do that same analysis, there should be serious valuation support, and especially for companies that are able to grow very rapidly during the next few years. Now, we don't think anyone will believe what I just said until it is tested and proven. So what that means, and what we believe could happen here, is the 10-year Treasury yield could move to that, or needs to move to that 3%, and we think it will get there at some point. It will take a while, but needs to get there, and then maybe fail because of this notion that nominal growth in the economy is closer to the 2 to 3% range. Now, why would that be? And so we think there are major deflationary forces evolving in the global economy now, and they're fighting this notion that all of this monetary policy ease throughout the world is going to ignite inflation. Well, we believe that point of view is going to be in a dueling match with the two deflationary forces. One is good deflation and one is bad deflation. So the good deflation has to do with technologically enabled innovation. It is deflationary by nature. It rides down cost curves, gains efficiency, gains productivity. This disruptive innovation is going to cause creative destruction in the traditional world order. And it's not just electric vehicles and DNA sequencing, it's robotics, artificial intelligence, blockchain technology. There is so much innovation taking place right now. And I don't think that investors appreciate how these S-curves are feeding one another as these innovations converge. The bad deflation is associated with what I just mentioned. These the disintermediation and disruption to the traditional world order is going to put a lot of companies at risk. Now, a lot of companies who thought they were steady eddies, and nothing really would ever change, whether it's in the financial services sector or the auto and auto-related sector, maybe the rail sector, almost any company associated with the internal combustion engine and suppliers around. I mean, this is a massive part. These are massive parts of the economy. Many of those companies have, because of shareholder, maybe the short-sightedness of shareholders, have adopted short-term time horizons themselves and catered to these shareholders. They have consistently leveraged up to buy back their shares and pay dividends. Now, we are seeing the result in formerly blue chip stocks. GE is one, IBM is another. There are going to be many more of these. Many are highly leveraged because they didn't understand how quickly the world was going to evolve. In fact, their time horizon wasn't 5 or 10 years. It was 2 years or until the end of the CEO's term. What's going to happen now, we believe, is they are going to be forced to cut prices in order to service their debt.
So to summarize Cathie's points, she acknowledges that there are driving forces for inflation today. She doesn't mention it here, but the first thing that comes to mind for me at least is the Fed's balance sheet. This chart gives us an idea of how much money they've printed over the last 12 months. Truly staggering numbers. However, if this is driving up inflation, think of it like a force pushing upwards, well, there are opposing forces pushing back down, deflationary forces. Specifically, as technology becomes cheaper, that pushes prices down. And as new technology begins to disrupt existing companies, these companies will have to cut their prices in order to service their debt. So those two forces, they're acting to push prices back down. So Cathie is basically making the point that she believes people are putting too much emphasis on the forces driving prices up and are not paying enough attention to the forces pushing prices back down. Therefore, she thinks people are overestimating how high inflation will rise. So, what does that mean for the stock market? Well, lower inflation means the Fed doesn't have to raise interest rates as high, so bonds and saving accounts remain entirely unappealing. Therefore, institutions leave their money in the stock market, and so while a dip may come because interest rates have to rise at some point, a crash is less likely. So both Chamath and Cathie Wood are concerned about how inflation could impact the stock market. And rightly so, because as global economies begin to pick up steam, the demand for goods and the velocity of money should increase, which brings inflation into the picture. Chamath sounds more concerned than Cathie though, with Cathie citing how deflationary forces could play a bigger role than people expect. Either way, it's just always interesting to hear the thoughts of two of the world's most influential investors, especially when they disagree, as it's often in disagreement that we learn the most. But I'm interested to hear what you think. Do you think higher inflation is coming? Do you think it's already here, but it's not shown in the official figures yet? Let me know in the comments below.